and welcome to Big Deal. Today we have with us the top team at Kotak Investment Banking, S. Ramesh and Saurabh Malik. Gentlemen, so good to have you on CNBC TV 18. So, of course, your business has improved vis-a-vis last year. 2017 is expected to be much better in terms of mergers and acquisitions and equity deals, Ramesh.
So there are three factors that seem to be contributing to this uptrend, and I would broadly agree with what you say. So after a number of years, we are actually seeing a situation where there is alignment of three big contributors to the investment banking business. We are seeing a reasonably high uptrend in the industry on advisory deals. So we ended calendar 16 with 65 billion, which is a record number. And as we sort of draw the decks for crystal ball gazing into 17, it looks like the trend can get better. Yeah. Secondly, the equity capital markets have been good. They continue to be good. They started in calendar 15. So we saw a good set of deals happening, investors making money. And for the first time in my history over 10 years, the pipeline got exhausted in 1 year. And private equity investment, which has been for the last 8-9 years very, very active, saw close to 13 billion. And that also offers opportunities to bankers. So this alignment of all the three heads of income for the investment bank, if I may call it, has sort of been a positive surprise for calendar 16.
Right. So sort of on the M&A side, of course, consolidation looks like the theme of these times, not just in telecom, but in financial services and even in consumer business and many others.
So there are about 4 or 5 reasons why we are seeing an uptick in the M&A cycle overall. So I usually break them up into what I call supply side and demand side drivers. So in addition to normal business reasons like consolidation or forward integration or backward integration, there are a few other supply side drivers. Stress. If there is stress at the overall group, they are looking to do transactions in certain pockets to relieve that stress. The other aspect also is financial sponsors. In quite a few of well-managed companies today, you have financial sponsors with a focus in terms of creating value for not just themselves, but for all shareholders. So these are some additional sell-side factors which really come into play because of which there is an uptick in M&A. In addition to that, so to say, the interest in overall India continues to remain quite robust in that sense, and there is an additional factor which is the so-called re-emergence of the domestic acquirer. There are enough and more Indian groups which are involved as potential acquirers in a lot of the M&A transactions that you have seen over the last 12 to 18 months. And the growth in the domestic acquirer business has been substantially more than overall growth in the foreign acquirer business, so to say. These are some additional factors which one are thinking about as we look at the trends going forward.
Oh, of course, domestic M&A has clearly picked up, and some of the Indian houses, and not the big ones, but the smaller ones have become more acquirers that we have seen at least in 2016. We'll come back to each of those, but Ramesh, talking about the ECM business, and especially the IPO street, we saw some very interesting names come up. But my worry has always been that the IPOs have not been for growth money, but to give exit to the financial sponsors or either to the promoters. What is the theme looking like in 2017, and how's the pipeline looking for the year?
See, we must put this point in perspective. So if you go back a few years, we hadn't seen so much robust private equity funding coming into companies. So we therefore had scenarios where a set of companies would actually go to the market, the IPO market, a little early stage. Today, I think with the dominant spread of the private equity investing culture that's come into India, what we are seeing is a little different trend. We are seeing, so if you go back from 2008-9 when the private equity investing started to sort of gain momentum in India, their tentacles are well spread into a number of companies into India. So therefore the growth investing has come into that cycle earlier on, and this is a stage for them to exit. So that's the way we have to look at this perspective. So roughly 85% of the IPOs were offer for sale by private equity. We think a large part of the trend will continue this year. They'll continue to encash. Secondly, I just want to go back to the point my colleague Saurabh talked in the context of M&A. So there has been a lot of debate about business confidence confidence? Is capital gaining new investment? So my perspective is, even if capital is not getting into new projects, but one set of promoters are investing into acquiring other set of promoters, in a way that's capital investment. So they're just continuing to build. And from a structural point, that may not be all that bad for particular sectors, because you'll see few players, more decent sell-side and buy-side economics. So this augurs well for some of the sectors. So that's the way I think we should try and look at what is happening.
So which are the sectors you think would this particular theme be dominant going forward as well?
Sectors today that are of interest are fairly broad. India is a fairly bottom-up story, but if you really think about it, we see activity in the broader industrial space. Financials is very, very active at this particular point in time. TMT, we don't need to, there's no debate, there's activity as well. Consumer also, there is activity. And infrastructure, not to forget that. I mean, that's a sector that really requires a lot of capital, and we are seeing quite a bit of interest in that space as well.
So funds are coming to the infrastructure sector, especially from Canada-based funds.
We are seeing a lot more interest from sponsors and funds into projects which have almost reached completion, where there are limited execution risks. And I think this is a good balance of capital and use of time. So the developers spend more time during the execution phase of the project, and the sponsors are able to take it forward during the rest of the life cycle of the project.
Okay.
I think leverage is contributing to some consolidation reasons. So one way of looking at leverage consolidation is what is when it gets into a stressed asset. But I will also refer to situations where it's not officially become a stressed asset, but we know that the leverage is high. And that's also making players look at M&A.
Of course.
And without sort of directly alluding to this, so if you look at the cement sector, and in particular now the steel sector, it's obvious what is happening there. So in a refined form of consolidation is happening.
Of course.
The second thing is on telecom and some other sectors, I think we are seeing on life insurance, you've seen. So some of them, players number 2 and 3, players number 1 and 3. So some form of rational consolidation is happening. So I think it's a very interesting space. So each sector and each situation, as Saurav rightly said, is bottoms up. And depending on the situation, intra those companies, I think some of those mergers are happening. I just want to make one more point. So if you compare India and Indian promoters to, let's say, 7-8 years back to today, there is a lot more emotional comfort in dealing with buying and selling of companies than what was witnessed before. So in a way, this is also contributing to a more practical way of looking at buying and selling companies.
I'm glad that you raised this point, Ramesh, because a lot of M&A was stuck, despite the companies being so stressed, was because the promoter was not okay with a deal in his company, and nor was he okay with the banks really taking over. That's why SDR also didn't work out that well, and S4A is also not working out, it seems.